Welcome to another deep dive.
Glad to be here.
Today, we're really getting into it, looking at the second quarter 2025 earnings for J.B. Hunt Transport Services. We've got the earnings call transcripts, the full financial report right here.
Yep, all the details.
And our mission really is to cut through the noise, the numbers, the corporate speak, and pull out what's actually going on in logistics and transportation, what really matters.
Absolutely. It's a complex picture right now.
You know, some people might think earnings calls are just, well, dry numbers.
Yeah, it can be.
But I think what's fascinating here and what we want to unpack is how J.B. Hunt is tackling some really big challenges. They've got these specific strategies, cost cutting, getting ready for a peak season that, frankly, nobody seems sure about.
Right. The uncertainty is huge.
So we're going to dig into those insights, maybe find some surprising facts, those aha moments. The goal is for you listening to walk away really understanding the freight market right now and how a giant like J.B. Hunt is, well, navigating it.
Sounds good. Let's do it.
Okay, so let's start at the top, the high-level view. What did Q2 actually look like for them, the big numbers?
Okay, so looking at the consolidated JAP numbers, the standard accounting.
Right.
Revenue for Q2 2025 was basically flat compared to last year.
Yeah.
Came in at $2.93 billion.
Flat, okay. And profit.
Operating income, that was down about 4%,
Yeah.
$197.3 million. And diluted EPS, earnings per share, also pretty much flat. $1.31 this year versus $1.32 last year.
Flat EPS, even with operating income down slightly. Interesting.
Yeah, and what's interesting too is operating expenses. Year over year, they were up just a bit, like 30 basis points, 0.3%.
Yeah.
But, and this seems important, they actually decreased compared to Q1 of this year, sequentially down 40 basis points.
Ah, okay. So some cost control showing up quarter over quarter, even if year over year is still tough. What were the main drags on cost?
They pointed to a few things. Inflationary pressures, no surprise there. Mainly driver wages, professional driver wages.
Oh, it's a big one.
Always. Plus casualty and group medical claims expense and just general equipment-related costs, maintenance, things like that.
Got it. Any bright spots in the financials?
Well, they did generate pretty strong free cash flow, over $225 million for the quarter. So cash generation is still there.
Okay, so flat top and bottom lines, basically, in what sounds like a pretty tough cost environment.
That sums it up pretty well.
Which brings us to this big initiative they announced, right? The lowering cost to serve thing. This sounds like their main answer to those asset utilization, yeah?
And using technology, engineer process improvements, all that stuff.
And they put a number on it, didn't they?
They did. $100 million. That's the figure for identified annual cost reductions from this first push.
$100 million annually. That's significant.
It is. But here's a key detail. They said some benefits will hit this year, 2025, but most of the impact will be in 2026 and beyond.
Ah, so it's not an instant fix. It's an ongoing thing.
Exactly. It suggests this is a program they expect to keep running.
Yeah.
Maybe find even more savings down the line.
Now, how are they achieving this? Is it just layoffs or?
They made a point to say it's not about mass layoffs, which is interesting.
Yeah.
Instead, they're really emphasizing using things like AI, automation.
The tech angle.
Right. To get rid of what they call non-meaningful work. The idea is to free up employees to focus on, actually growing the business. It also seems to involve more collaboration between their different divisions, sharing resources, finding efficiencies that cross those internal boundaries.
Makes sense. Any specific examples? You mentioned asset utilization.
Yeah, they gave some examples there, like if they have excess trailers in one part of the business, maybe intermodal, they're trying to use them to replace leased trailers in, say, dedicated or final mile.
Okay, shuffling assets internally.
Right, or exploring maybe leasing some of their own equipment out to others, and working with BNSF, their rail partner, to cut down on costs for storing equipment they're not using. Just trying to sweat those assets harder.
That $100 million figure is definitely eye-catching, especially with inflation still biting. So given this internal focus, what are they seeing externally? How's the market looking and how are customers behaving?
Well, the overall market demand trended a bit below what you'd call normal seasonality.
Yeah.
So a little soft still.
Still soft. Okay.
And customers are definitely reacting to all the talk about global trade policy changes. Tariffs, nearshoring, all that. It's affecting when and where freight is moving.
So more unpredictability.
Definitely. They mentioned, for instance, there was some market tightness back in May around the annual road check event.
Right. Inspection week.
Yeah. But it didn't last. Truckload spot rates stayed soft, which basically tells you there's still too much truck capacity out there overall.
Still an oversupply.
Seems like it. And customer conversations, they said, are really focused on optimizing everything dynamically. Supply chains, capacity plans, service needs, budgets. Everyone's trying to adjust on the fly.
But are customers sticking with them or shopping around more?
Interestingly, they said they're seeing some of their highest customer retention numbers in the last 5 years.
Really? In this market?
Yeah, which they say is leading to more strategic talks during bid season
Hmm.
and even opportunities to pick up more freight from existing customers, despite the soft market.
That's counterintuitive almost. Higher retention when maybe you'd expect more price shopping?
It suggests maybe service and reliability are becoming even more valuable when everything else feels uncertain.
So, with all that customer shifting and market softness, forecasting must be a nightmare. How are they handling that? Especially thinking about peak season.
Yeah, you nailed it. Forecasting is a huge challenge. For their customers, too. They emphasized how diverse their customers are, different sizes, different industries, and everyone's tweaking their supply chain for their own reasons.
Right.
So you get some customers who pulled freight forward earlier in the year. Others are sticking to more of a just-in-time, demand-driven approach. And then you have others making bigger changes, like shifting manufacturing or sourcing countries.
So, a real mixed bag of strategies out there.
Totally mixed. And that complexity, that lack of sort of clear forecasting from customers. That's why J.B. Hunt is starting its peak season surcharge programs earlier this year.
Ah, trying to get ahead of potential surges, even if they don't know exactly when or where they'll hit.
Exactly. Their stance is basically, we don't know what shape peak season will take or how volatile it will be, but whenever the demand shows up, we plan to be ready for it.
Okay, let's dive deeper then. How did these dynamics play out in their specific business segments? Intermodal is the giant, right? Let's start there.
Right, Intermodal, JBI, volume was actually up 6% year over year.
Okay, positive volume growth.
Yeah, but the mix changed. Transcontinental loads, the long-haul east-west stuff, that actually decreased 1%.
Oh.
But Eastern network loads grew a lot, up 15%. They broke it down by month, like April up 11%, May 3%, June 4%. Strong growth in the East.
Why the growth in the East specifically?
They said it's customers continuing to convert freight from over-the-road truck to intermodal. Even with truck rates being low and fuel prices down a bit, the argument is that J.B. Hunt's service levels with the railroads are strong and it still offers a valuable cost saving. So highway conversion is key there.
Interesting. And what about pricing in intermodal? That's been under pressure for a while.
It has. But they said this bid season, they actually achieved positive pricing overall for the first time in 2 years.
Positive. Okay, a turn.
A modest turn. The whole book of business repriced slightly higher year over year. They got increases on the main head haul lanes.
The primary routes.
Right. But that was partly offset by pressure on the backhaul or return lanes. So still some give and take.
How did they feel about that outcome?
Their assessment was sort of mixed but positive. They admitted they underperformed what they wanted on rates. They never get as much as they hope for.
Ah, fair enough.
But they felt they were really successful in balancing their network, getting that east-west mix better, and growing by converting that highway freight. That seemed to be the big win for them.
Anything else notable in intermodal?
Yeah, actually. They highlighted the launch of their quantum service in Mexico. They called Mexico their fastest growing channel and see a really long runway for growth there. So that's clearly a strategic focus.
Mexico keeps popping up everywhere in logistics.
It really does.
Yeah.
And for margins in intermodal, they think these cost initiatives plus that modest rate improvement can stabilize things and maybe lead to modest improvements from where they are now.
Yeah.
They stress it's like 3 equal parts: growing volume, taking out costs, and getting price.
Oh.
All needed to get back towards their target margin, which they said is at least 10%.
Okay, that Eastern network growth converting from highway is definitely something to watch. Let's switch to dedicated DCS. That segment usually feels pretty stable.
Yeah. Dedicated is known for being resilient, and it was. Revenue was flat year over year.
Flat, okay.
But productivity was up. Revenue per truck per week increased 3%. If you exclude fuel surcharges, it was actually up 5%.
What drove that productivity?
Mostly their contracted price escalators kicking in,
Yeah.
index-based adjustments.
Yeah.
And also they had less equipment sitting idle.
Makes sense. What about the fleet size?
They ended Q2 with 115 more revenue-producing trucks than they had in Q1 this year. So sequential growth. Still down about 150 trucks compared to Q2 last year, though.
Got it. And are they still selling new dedicated deals?
Yep. Sold about 275 new trucks worth of business in Q2. They said they're on pace for their target, which is selling 800 to 1,000 new trucks per year,
Yeah.
unless some big known customer losses materialize that they'd previously flagged.
So growth is expected in the second half.
Net fleet growth, yes. But they did caution that startup costs for bringing on that new business might weigh on operating income growth a bit compared to 2024. That's pretty typical, though. These new deals usually take like 3 or 4 months to become profitable.
Right, the ramp-up period.
Exactly. But overall, they really highlighted DCS as strong, diversified, resilient, high customer retention, around 92%. It's kind of their anchor.
Okay, good old reliable, dedicated. Now, what about the brokerage side? Integrated Capacity Solutions, ICS. That market's been brutal.
Brutal is right, but actually some significant improvement here.
Oh, yeah.
Yeah, their operating loss got much smaller.
Yeah.
It's $3.6 million in Q2 this year. Compare that to a loss of $13.3 million in Q2 last year.
Wow, that's a big swing in the right direction. Almost break even.
It really is. And interestingly, revenue per load was up 6%, even though their total volume was down 9%.
Huh. Better quality loads or better pricing discipline, maybe?
Could be a mix. And their gross profit margin improved too, to 15.5% from 14.8%.
So how did they cut that loss so dramatically?
Well, the slightly better gross profit helped, but mostly it was cost reduction. Lower people costs, lower cargo insurance, lower tech costs. They specifically mentioned taking out over $3 million in operating expenses year over year. Things like adjusting span of control for managers, improving efficiency. They also said $35 million in costs they had in 2024 just won't repeat this year in ICS.
So, real structural cost changes there.
Seems like it. Oh, and another point, their carrier base, the number of trucking companies they work with, actually grew 8%. That's after it had been shrinking because they tightened up qualification rules to fight cargo theft.
Okay, so maybe stabilizing the carrier network too. Overall, sounds like ICS is making real progress on getting costs right and finding profitable business. Finally.
Yeah, that's the clear message.
Yeah.
Progress towards profitable growth.
Okay, quickly then, the other two segments. Final mile and truckload. Any highlights there?
Sure. Final mile services, FMS, that one struggled a bit. Revenue down 10%, operating income down 60%.
Ouch. Why?
Mostly just general demand softness, especially for big and bulky stuff. Think furniture, exercise equipment, appliances. Demand for those deliveries was down.
The post-pandemic slowdown in home goods continues.
Seems like it. Then truckload, JBT, that was kind of a mixed bag. Revenue was actually up 5% and load volume was up 13%. They said it's their highest Q2 volume in over a decade.
Really? Strong volume, but...
But operating income was down 5%. Mainly due to higher costs. Again, casual fan echo claims hit them here too, plus higher maintenance costs.
So costs offset the volume gains.
Pretty much. On the plus side for truckload, though, they did improve trailer turns. How quickly they reuse their trailers up 17%. They put that down to better network balance and just general efforts to use equipment more efficiently.
Okay, so lots of moving pieces across the segments. Pulling it all together, what does their balance sheet look like? And their capital spending plans? Does it signal confidence?
Yeah, looking at the financials overall, their balance sheet is strong. They said it's right in line with their target, which is leverage of about 1 times their trailing EBITDA.
1 times EBITDA, that's generally seen as pretty healthy, conservative leverage.
Very much so. And they're still generating strong cash flow. Expect that to continue. Capital expenditures, CapEx, they actually tightened the range for 2025. Now expecting between $550 million and $650 million.
Down slightly or just more precise?
Seems more like just tightening the range.
Yeah.
They said it's mainly for replacing older equipment and for success-based needs in Corcoran. Dedicated, basically, buying trucks for those new contracts they're winning. A key point they made was that a lot of their future growth and capacity needs have already been pre-funded through past investments.
Ah, so they don't need massive CapEx right now to position for growth.
That seems to be the message. So the primary use of their cash right now is managing that leverage target and returning value to shareholders, dividends and stock buybacks.
And speaking of buybacks...
Yeah, that was notable. They had a record quarterly stock repurchase in Q2, $319 million spent buying back about 2.4 million shares.
Wow. That's a pretty strong signal from management that they think their stock is undervalued, right?
Absolutely. Putting significant cash behind that belief, it definitely signals confidence in the long-term value, despite the current tough environment.
So taking that confidence, the cost-cutting, the segment performance, what's the big picture message? What's the path forward for J.B. Hunt, according to them?
They definitely acknowledge it's been a challenging few years, a prolonged, tough environment.
For sure.
But their message is very much, we are operationally excellent. We are set for growth when the market finally turns, when it inflects.
Position for the rebound.
Exactly. They talked about a huge addressable market, $600 billion.
Mm.
They believe they're offering the highest level of service and have really positive customer sentiment across all 5 business units right now. And fundamentally, they believe they have the right people, technology, and capacity ready for whenever that inflection happens.
So it's about execution now and being ready for the turn.
Right. The core objective they kept coming back to
Mm.
was grow the business, but do it while lowering costs, repairing margins, and ultimately growing earnings.
Mm.
It's that dual focus.
Okay. As we wrap up this deep dive then, here's something to think about. You see a company like J.B. Hunt in this period of, constant economic shifts, market ups and downs,
Hmm.
and they're really doubling down on internal things, cost efficiencies, customer service, even when the market is soft. How does that intense internal focus position them not just to get through it, but to actually accelerate when things eventually pick up?
It's about controlling what you can control, right?
Exactly. So the question for you listening is, what internal levers can you pull in your own work, your own business maybe? How can you focus on that doing more with less idea now to be ready for whatever opportunities come next?
A great question to ponder.
Indeed. Well, thank you for joining us on this deep dive into JB Hunt's quarter. We hope you found it insightful.
Hope so, too.
Definitely continue exploring. Think about how these ideas apply. Thanks for listening.